All right. Good morning, everybody. Happy Tuesday. This is the morning show here on Stock Market TV. Spencer Israel, JC Parets. We'll have Steve Strazza hop in a minute. A lot to discuss. Things are getting interesting out there. Things have been interesting. I mean, one of them not interesting, but things are more interesting, shall we say. I like the title of JC's note this morning. Was it The Good, the Bad, and the Ugly? I think that's what it was. Does that sound familiar, JC? I think that's what you wrote. Yeah, we got a lot to talk about. And it's a good day to have Mike Hurley on the show because he is one of our favorite technicians, analysts, strategists, whatever you want to call him. He'll be on at 9, and we'll have a special guest join us for that Mike Hurley interview at 9 o'clock. So a lot going on today. We got Mike, we got special guest, we got Kenny, we got you, we got me. We got the market. We got the futures. They're up. It's all good, right? I don't know. All right. Drop me a like, please, and thank you. Good morning, chat. Let's get this show on the road, and let's see where the road leads us.
All right. Good morning. Good morning. Let me just tell you how fortunate we are to have Mr. Mike Hurley on today.
Oh, yeah.
Mike Hurley is he's a mentor and an inspiration to me for sure. Strazza, this is a guy whose work has inspired us big time. Mike Hurley actually won the Lipper Award for Best Mutual Fund in 2008.
That's a big year to win that award.
It's a big year to win that award.
Yeah.
100% technician, portfolio manager, just absolutely crushes it. He's the man. So folks listening out there, trust me, you are in for quite the treat today with Mr. Mike Hurley. Shout out Mike Hurley. Mike Hurley and Katie Stockton used to work together like 25 years ago. I don't know if you knew that.
No, I didn't. But as always, it's a privilege to talk to these people. And
small world.
Yeah, that too. All right. I know Strauss is going to pop in a minute. Do you want to do state of the markets?
Let's do it.
All right. We have some markets to state.
All right, ladies and gentlemen, we've got the Dow futures up 35 points this morning, just under 42,000. That is the big level. That has been the big level. It still is, and we're right there. Talk about the market pinning it to key levels. S&P also just above a key level in this case, 56 and a quarter. That 5,600 for the S&P 500 is a big one. 5,600 for the S&P, same to me as 42,000 for the Dow. Key levels, NASDAQ 100 futures, we're looking at 19,500. Just below that, up 32 handles this morning, leading the way higher, slightly higher, not that aggressive to the upside, but slightly higher. 30-year bond futures are pretty much flat, just under 118. Crude oil up 1.25%, back up towards 67. Copper up again, 1.6% in copper. Getting close to that $5, $4.75 for copper. Gold up 0.75%, 29.20. Silver up 1.4% this morning, pushing 33 with the VIX just under 28. I'll say that again. The VIX just under 28. Over in funny money land, you got Bitcoin rallying this morning up almost 4%. That's 3,000 points for Bitcoin, 81,600 for BTC. You got Ethereum at 1,900, up 2% on the day after getting hit pretty hard. Solana, 123, hanging on for dear life to that key level, up almost 5% on the day. Total crypto market cap, Mr. Spencer Israel, 2.6 trillion, 2.6.
I was just talking before you hopped on with our surprise guest that'll join us from Mike Hurley. About how 5 years ago we were like in the midst of like the COVID crash, and now here we are 5 years later. No COVID, no pandemic, and crash is probably a strong word, but we are in the midst of something, little something's going on.
Yeah,
Yeah.
it's hard to call it a market crash with the German DAX hitting all-time highs and the
I
Hang Seng hitting 3-year highs. If there's a real credit event, I know people like to make up fairy tales about credit events, like that's like a thing. If there's a real credit event, those things are not happening.
well, at least in the US, things are happening, and not in a good way for the bulls. Um, every day, I come in and I look at, the pre-market movers, and there are stocks gapping down 10, 20, 30, 40%. And today is no different, right?
You like my title? You like my title for my post this morning?
Yeah, was that right? The good, the bad, the ugly. Did I remember
Good, the
that?
bad, and the ugly. You like
Okay.
that? Are you too young to know what that is?
Uh, I've actually never seen that movie. Sadly, I've never seen. I know it's a trilogy. I've never seen any of those movies.
At least you know it's a movie.
I know it's a trilogy. I
No,
mean, that's pretty good.
the kids these
But
days, they don't know.
I've never seen any of that trilogy.
Why
So,
don't we go over the good, the bad, and the ugly?
okay.
You want to?
At least I think it's a trilogy. I could be wrong. Try to correct me if I'm wrong. Yeah. We have
Let's look at the
charts.
good, then we'll look at the bad, and then we'll look at the ugly. Let's
All
Let's
right.
start with the good.
Yeah. 1 second.
Start with the good over here in slide 2.
All right. What's this?
So just alluding to what we were talking about before. If there's like a real credit event out there, if this is like really like a massive global recession and destruction of equities and all of the value that's been created, and you're not going to see these things making new highs, right? Could you? I suppose anything's possible, but let's just say very highly unlikely that if the world was coming to an end, that these would not be doing what they're doing. So this is the good. This is probably the best thing that's going on in the market right now. Let's talk about the not so good. I got 2 charts here. First of all, we're looking at semiconductors. Semi's making new 52-week lows on a relative basis. Not good. Not good. I would argue probably bad, if anything, right? Certainly not good. In order for the market to invalidate any of the bearish implications by this top completing, you got to get back above those lows. Got to get back above those lows. And if they do, I would say that's pretty damn impressive. If you have any ambitions of making money on the upside in technology stocks in the foreseeable future, you're going to want to see this getting back above those levels. That's a big one. And then here's the next one. So this one, I would argue just as important, right? Just as important as semis. We're looking at home construction. Have not broken down. In this case, we're looking at it on an absolute basis. So if you are bearish and you think the stock market's going to fall apart and, the Trump is the administration is terrible and the wars and like all of these things that they've been telling us for 2 years, if you think that any of that is true and you think the stock market's going to fall, this one I think needs to be front and center. I think the bears really want to see home construction breaking down. This is a big one. Strazza has been pounding the table for a while now that home construction stocks are really just industrial stocks. And I kind of like laughed and giggled a little bit. I was like, yeah, maybe. But no, he was absolutely right. These things have been trading with industrials. They have not been trading with consumer discretionary. So this one I think is front and center. So the good is Hong Kong and Japan making new highs. Certainly there's nothing bad about that. The not so good, or the bad, if you will, is semiconductors completing this top on a relative basis and home stocks completing this top, the top on an absolute basis. I think there's an echo, Strazza.
Wait, that was no. It should be fixed.
Good morning, Strazza.
Hey guys,
how's it going?
But I think we're past the point of looking for things that'll be in place if the market's falling apart. Market already fell apart.
No. Stop.
Down 25%.
You don't think that home construction stocks breaking down to new lows creates a much bigger structural problem for risk assets?
Yeah, but I mean, you're pretty much there. All the other key levels broke. We made the bear market checklist.
First of all, they have not broken. The Dow's still above 42,000. The S&P 500 is still above 5,600. So that is not true at all.
We've had different levels then. My levels are all broken. I'm putting out the checklist today.
Well, just because your levels are broken doesn't mean that I give a fuck about your levels.
The market's got
my levels on the Dow at 42 and the S&P at 5,600 have been in place for like a year.
No, I let you know last week we talked about it. If you heeded these obvious warnings in the market, you've done well. If you raise some cash before all this volatility, it's really ugly out there. It's not good. Doesn't look like it's getting better either.
Right. So like I said, 5,600 on the S&P and 42,000 on the Dow, in my humble opinion, are the big levels. I think I'm not going to say that home builders not breaking down is a bad thing. No, home builders breaking down and completing that top, I think creates bigger structural problems for this market. And I think on the flip side, if semiconductors were to break back above those key lows, I think it would invalidate a lot of the bearish implications that we've seen. And then here's the worst part, right? Here's the ugliest data point, I think. And this is the percentage of stocks above their 200-day moving average on the New York Stock Exchange. So the New York Stock Exchange is, in my opinion, the most important universe of stocks that we have. Because not only do you have a lot of the big American stocks, you also have a lot of the big international stocks. You get a lot of foreign exposure on the New York Stock Exchange. So, you can't cherry pick and say, oh, it's only America, or oh, it's only international. Like, this gives you a pretty heavy dose of both. Obviously leaning towards America, but certainly giving you a lot of international exposure that you're not getting in the NASDAQ, that you're not getting in some of the other indexes. So this is definitely a big one. To be fair, this level was substantially below this in the fourth quarter of 2023. We got down to the 20s. Right now we're in the 40s. For a healthy market environment where we have broad participation, you want to see this in the 60s, right? You really want to see this in the 60s. So again, in the fourth quarter of 23, you got down to the 20s. So it's not like there isn't any precedent for, to see corrections throughout bull markets. We've seen them. We've seen way worse than this, right? Way worse than this during this bull market. And things could get worse, no question. I'd be surprised if they did it, to be perfectly honest, right? For some of the reasons that Strazza was alluding to. But when you want to gauge the overall health of the market, you really want to see this thing in the 60s.
I think the major averages have further to fall. If we could throw up I'll share some charts from the bull market checklist after our.
How excited are you for Mr. Mike Hurley?
Look, it's a great time to have him on. I want to know, like, if there was evidence of a fall day before we rolled over and all that stuff. I don't know if we had that this cycle, so that's crazy. But throw up the VWAP chart. So this is the VWAPs from August 5th, and they continue to be the level. Do you have them in there, Spencer? I'm looking for a deck.
No, I don't.
Do you think there's any chance of a bullish momentum divergence potentially developing in Bitcoin, or do you think there's zero possibilities of that?
It's just too soon. Look, I'm happy to dip my toes back in and get long Bitcoin in the future, but now's not the time. That's not the question I'm asking.
And if we're above the February lows, still no?
Dude, I'm not a buyer of cryptos. I just sold after being long, very long for 2 years, all of my cryptos.
So you're saying your anchoring bias is not allowing you to see the potential bullish divergence, or you just don't? Because where you sold it and where you bought it is completely irrelevant to what the market is going to do.
It's typically
the market doesn't care what you did, how much money you made on the way up, how much money you saved on the way down. The market doesn't give a shit about any of those things.
Yeah. So I've done this a couple times by now. So I'm used to getting in at the beginning of a new primary uptrend and getting out at the end of a primary uptrend. There tends to be a period between the primary uptrend and then the primary downtrend that ensues before you get another primary uptrend. So from doing this year over year, cycle after cycle, it would be very strange if I got right back in right now. That would be a very abbreviated cycle. So I'm not planning on it, but I'm open to it.
How should we think about just a massive underperformance from Ethereum? Like, is this just more of the same, or do you think there's something else that we need to take away from that? Or is just Ethereum has sucked for so long, just more of the same?
I was talking to Alfonso yesterday and I was mind blown. I said, dude, we never talk about Ethereum. I said, have you realized, like, we don't write about it, we don't talk about it. We've been treating this cryptocurrency like it literally doesn't fucking exist.
True.
Like, all cycle. It's the second largest one still.
By a long shot.
So I would say, to answer your question, I would say we're going to keep ignoring it.
No, I mean, that was kind of like what I was like. That was kind of like how I was asking you. Like, are we just going to continue to ignore it? Because who cares? It's just a piece of shit.
We were talking about it yesterday. He was using it for a post, and I was like, stop, wait. It's like, have you noticed that we just never talk about this one? We'll write about Solana, we'll write about the ripples even, but never really Ethereum. So I don't know. It's information.
Ethereum just never broke out. Like, so So Bitcoin broke out, Solana failed to break out, and then Ethereum never even tried.
Ethereum, the Intel of crypto. You like that?
Ethereum, the Intel of crypto. Wow. Wow, is that a low blow too soon?
Or is that a little too mean to Intel?
Maybe this.
I was gonna say it's a little mean to Ethereum.
It's a little too early.
Hate.
It's too soon. It's too soon, but maybe, in the future, we'll have a lost decade or something. Then we could call it the Intel. I don't know, JC, to answer your question. I'm open-minded to a lot of things, but the conditions I'm seeing for risk asset markets broadly, I disagree with you on credit spreads. I disagree with you on the risk appetite ratios.
You
the
disagree
way that
with me on credit spreads? What did I say about credit spreads out of curiosity?
failed breakout in the HYG IEI.
When have I mentioned credit spreads today?
I overheard you talking about the bond market, not saying there's signals of any stress.
No, what I'm saying is if there's a massive credit event, in other words, if there's going to be this massive global recession and all of these things are going to get destroyed all over the world, then Hong Kong and Germany are not making new highs in that environment. Like that's my only point. If you're weighing if you're saying what's the good, the bad, and the ugly, the good news is that you're seeing a ton of risk appetite globally. The bad news is that you're losing key sectors. And the worst news is that participation, you have very few stocks at this point in uptrends.
Can you weigh the SMH and the German DAX equally? I mean,
no.
That's 10 times, isn't it 10 times the size of.
No, I would say Spencer's probably onto something. They're very different, first of all, which is why I could compare them, because it's not like, oh, you're just double dipping. Like the German DAX is one animal completely, and semiconductors are another animal altogether.
I have a problem.
Equally as important.
You're taking these two, frankly, obscure markets when you compare them to the
semiconductors and the German DAX.
Hong Kong and the German DAX. And here's the problem.
Those are obscure now.
Here's the problem with this kind of analysis. You've completely run out of bullish evidence. And this is just the only thing left on the list. Last week, you were saying things like, well, look at financials. The market's not going to roll over. Look how good financials are. And then they kill them and you lose them like that. You'll lose Germany with the same speed.
Maybe.
And this is, frankly, the way a market looks before it crashes. I'm not saying the market's going to crash. But this is the environment and the setup before a crash.
Maybe. Talk to me about credit spreads. What are you seeing there?
Failed breakout at the prior cycle highs, hitting new multi-month, multi-quarter lows. And then it's also, JC, the way things broke, the way we blasted through the prior cycle highs and printed failed breakouts across the board. I mean, look at the candlestick in large cap software yesterday. The way they resolve matters to me. They didn't test the waters and check out these levels. They literally just smashed through them.
The strength in consumer staples. We talked about it last night. By the way, Spencer, can you drop the link to last night's video? I thought that was really good. Well done, Steve.
We're going to continue to find uncorrelated trades and corners of the market that are showing relative strength. The problem is they're fewer and fewer. And they're harder and harder to come by with every.
I'll tell you this. So drop the link, guys. If you missed last night's video, definitely check that out. One of the things we talked about was consumer staples. Consumer staples breaking out on a relative basis is not good for the market. Those are things you see in market crashes. Not that the market needs to crash, but those are the types of things you see. But what also is really interesting is that there's money to be made in consumer staples, right? As we talked about last night.
Some of these staple stocks look fantastic. I can only get so excited about them, but we are trading them. We will trade them. It's not like we have a no staple.
Wow. You notice that the consumer staple stocks that are working the best are not the fake consumer staple stocks like Costco and Walmart?
Because they're too offensive. There's too much offense in there.
You see how Costco and Walmart are not acting like consumer staples? You know why? Because maybe they're not.
Bro, Kroger for the win. We went to Dion's this morning. Eggs were over $10. Carton of eggs was over $10.
Dude, eggs are down like 25% in a week, bro.
Yeah.
$10.
They're all
your breakfast joint. They need to get with the program.
They're definitely off the highs. They're high, but they're off the highs. Right.
Yikes. Okay, I have one more very, very important thing to say.
I'd be selling naked calls in eggs right now.
This is so important. Listen up. Donald Trump does not want the stock market to go down. This is not a part of some master Trump administration plan where they're tanking the market because then they're going to force Powell's hand to cut interest rates. Absolutely not. Just because he wants to move the field goal posts, again, of how you measure his performance, does not mean that he's sitting back like, ha, 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 we're coordinating a market sell-off and it's on purpose. It's not. This is bad, and they're completely panicked, right? So all the people out there like, oh, this is Trump's plan. Block them, mute them, run from them. They're crazy. Their minds are so polluted they can't see what's clearly right in front of them. The president doesn't.
Are people really saying that?
I think that is why we got that Trump bump after the election, because people, I think correctly, Steve, assumed like, okay, here's a guy that like really like the second or third priority on his list is the Dow Jones, right?
Yeah.
It goes like himself, Dow Jones. Right?
And that's something that market people grew to like expect and liked, you know?
Right. So like, how bad is it going to be with a guy who really wants the market to go higher? That was, I think, the impetus for the rally in November. And that's why today is interesting, because JC, earplugs, there's another meeting today in the White House with all the heads of all the big banks are coming in, and they're going to be like, yo, you gotta fix this, right?
As long as we get an SNL skit out of it, I'm good with it.
Okay.
They thought they were just gonna like cyberbully countries like Canada, and then Canada like didn't blink, and they're like, no, we're gonna leave our tariffs, right? And then now the market's been like, oh shit, this isn't just like some song and dance to try to get better deals for the U.S. Like this is actually gonna maybe be something. I talked about recession on here last week. You guys laughed at me. Everybody's saying recession. I'm hearing this word so much the past few days. Recession. It's almost like the market.
Fortunately for a lot of us, recessions are a choice.
Wow.
Steve, the whole recession thing has been like, I think people sometimes they almost like wish it would happen in a way, right?
Yeah.
And it's very hard to decipher who actually thinks it's coming versus who just wants it to come.
See, that's me. See, right? I don't think it's coming, but I want it to come.
Everybody has an agenda, you know.
Right.
Yeah, I've got my agenda. I hope the recession is the worst one we've ever seen ever. I just don't think that's what's going to happen.
Okay.
You know?
Nobody wants that. You're the only person that wants that. Nobody else wants that.
I'm good with that. Hold on. Strazza, I want to hear your thoughts on this.
Yeah.
Dude, this dollar is getting destroyed again today. Like, at what point is enough enough?
It's not good. It's not good. I don't even know what it means, but I know it's not good.
Dollar is getting smoked again, dude. The euro's up 80 basis points. British pound's up another 60. Wow.
The market hates it. It's an alarming rate of change. And here's the problem. You talk about these strengths in the international indexes, at least the ones denominated in US dollars, they've been buoyed by the dollar absolutely collapsing. If the dollar just digs in and gives us one green stick, you could see some of these international ETFs
20%. Yes.
Yeah, right. Then,
agreed. Yes.
And that could happen fast. These are like gappy instruments, right? They'll be down 3-5%, a little gap down day. Something like Hong Kong, 10% in a day. That's like walk in the park.
I'll give you that. Yeah, sure. But man, this is like, you know, you don't see the dollar getting destroyed like this like every day, you know?
And here's the thing. I'm letting the market like decide for me. It's scary because the market's telling me it's scary, right? I would have expected risk assets to be doing very different things with the dollar down where it is right now, but they're not. That's the scary part about it. So.
Yeah, the international relative strength is not a surprise. It's the lack of bid in U.S. stocks that's more the surprise, right?
And JC, I know you don't care, but like everyone is underexposed to international, right?
So no, I do care about that. What do you mean? That's been part of the bullish thesis.
They still are.
Right. Yeah. No, I mean like everyone is underexposed. Therefore, Germany and China and all that, it doesn't matter because like I don't own it. I mean I do, but I'm like so underexposed. It's disgusting, right? So it doesn't affect my life in the same way that like the home builders or the semis or the financials do, right? Or technology, right? So, you know, and that's how we're all, maybe not you, but the rest of us are in kind of the same boat in that we're all overweight America anyway. So, because how could you not for the last 16 years? So that's why people are upset, and that's why people don't jive with but Germany argument, right? Because
I'm not
Nobody
arguing
owns
for
it.
people's portfolio. I'm not. First of all, I'm not arguing for people's portfolios or whether they should be happy or not. I'm just
yeah,
arguing about weighing the risk appetite around the world. Is really what
yeah.
I'm saying.
There
I
are
don't give a shit about people's
certainly
portfolios.
there are pockets of risk on.
Yeah.
Sure, sure, sure.
Here, throw up slide 2 because
Hold
this is a
on,
big one, right? We're
JC.
talking about
There
Elon.
are pockets of risk always. I mean, almost always. There are
JC,
pockets of risk,
Not
right?
always.
would you agree that based on the weight of the evidence, the odds favor Germany catching down, not US catching higher to Germany?
Well, even without the weight of the evidence, I mean, think about. I haven't done the math on the percentage above their smoothing mechanisms, but like a mean reversion is very likely, regardless of what was happening in the United States, right?
They're super extended, and actually those charts
Yeah.
are interesting.
Yeah.
They're as extended as they've been in multiple cycles, a lot of them.
So what do we think about this? This is, and then we'll bring in Kenny.
Okay. Yeah, man, what a disaster. We're going to mark this chart up in the future with pictures of Elon, like, you know what I mean, or Mike Myers doing his dance in the White House, because that happened, JC, that happened right there at the top. Happened right there at the top, right? Elon becomes chief of White House, and then the stock craters, what, 50% more? Terrible.
And it happened at the same time that Solana failed to break out, the exact same time. So you had from failed breakouts come remember, as bullish as we were Tesla, those former highs were the targets. And then, we'll reevaluate when the time comes. And, that's why resistance exists, right? This is literally what you're seeing. Now, with that being said, based on the way the market was acting, I would have expected some kind of like consolidation, some digestion, maybe another attempt and a fail perhaps, and then kind of turn around. Not a complete collapse in the stock. So not what I expected at all.
Nope, neither.
This is a lot worse than what I would have expected. I would expect some sort of absorption of supply, but not this.
I was involved, but like we had a really clean and clear level. I was long this, but you had those power cycle highs, so you should have, if you were responsible, been out a long time ago. And this price action, man, is really starting to feel like early 2021, where the rest of the market was pretty much okay, but some of the most speculative, highest risk assets were getting absolutely crushed, like behind the scenes. Nobody was talking about it. Things like Tesla were down 30-40%. January, February 2021. ARK was down 35% just in February of 2021, right? But the rest of the market was kind of like whistling through the graveyard. But when you looked at certain charts, they looked like this, or Palantir.
Well, they didn't look like this. They had gone parabolic and started to come down. This just got back to the former highs.
Yeah, they came from a lot further. I guess. You're right.
Yep. And then just to be clear, I'm not looking for the world to burn so that I can be right. I don't have those kinds of insecurities. Like I know a lot of people have those insecurities where like they have to be right. I am not one of those. I'm literally just here to make money. So when I kid, and I'm not 100% sincere that I want the world to burn, but it would be nice if the market crashed by 75% so I could buy things on the cheap and get that beach house for next to nothing. Like that would be nice. Yes. Selfishly, that would be great. It has nothing to do with me being right. Like, and if you're one of those insecure people that has to be right, like you're going to be in a lot of trouble because the market likes to penalize people for trying to be right. Right, Strazza?
Yeah. I'm glad. Totally. It's crazy. And you sound mean when you say it, but I understand. I understand the mindset that you're trying to maintain because that's important as a trader or as an investor.
But I don't have any say in the matter. I can tell you what I want, but more often than not, I don't get what I want.
I want people to make money and be happy.
I don't care what other people do with their money.
I think one hole is really nice. He said, I'm given fundamental and technical reasons. That's great because in times like these, like I'm a big look and feel guy, or I'm a big feel guy, right? So I'm just kind of feeling stuff and seeing the charts and watching the tape, and I get these feels. I get big feels. So I'm glad that you guys think that this is rooted in some sort of process or research. That's great.
Yeah, and then also keep that in mind.
I was going to say Steve Strazza and George Soros. They both feel it in their gut.
But you want to know something? There's something to be said for that. A lot of people are like, just stick with your math. The math. Don't listen to your gut, et cetera, et cetera. I have studied a lot of behavioral finance, and a lot of the experts in this field, and they say that there's something there. There's something real about, and you see it in sports. You know, like when you're playing shortstop or second base, you can kind of feel where the ball's going to go based on who the pitcher is and where how their batter is lined up. You know, you can kind of get a feel. Should I shuffle this way? Should I shuffle that way? And set myself up. You don't know what's going to happen, but you have a feel for it. Same thing with like, football, when you're trying to like, break some ankles or something, you have a feel for which way the linebacker or the safety is going to go. Same thing in basketball. Like I have a feeling that he's going to bite. If I fake this way, then I'm going to go the other way. Like there's a feel for it in sports. So if you've played sports, like, you know what that's like. And in the market, I've studied, behavioral finance folks for many, many years. And pretty consistently, they say that the gut, there's something to that. And I would agree with that.
All right, let's bring Kenny on, and then we have her working on Hurley and our surprise guest. So Kenny Glick, here we go.
Guess.
It's been a long time coming. They ain't come for my club, they tugging. Putting up numbers, 99 pounds, and I still kept it 100. Hola. Yeah.
Ooh, Kenny Glick in the house. What's up, my man?
Nothing. We've been ripping for the last hour, talking about sentiment and this guy, Jimmy. Long story short, we had a member of our room where, the mantra, the market never goes down. I was teaching this guy, Jimmy, about IPOs. It was a new IPO, Yext, if you guys remember specifically. And I was talking about how stocks that come out of IPO, if it's under $10, if it breaks through 10, you get 1250. 1250 gets you 15, 15 gets you 1750, these levels. And me and Jimmy were high-fiving in cyberspace, loving it. And I'm just like, Jimmy, man, this stock, if it breaks into the 20s, chances are we're going 22.50 and 25. And then Jimmy's like, yeah, we're going to 30. I'm buying $30 calls, Jimmy. We're getting paid. And next thing you know, Yext has a blow-off top and rolls over, goes red, and I changed my attitude completely. Jimmy, we're screwed, Jimmy. The stock's going to zero. And you know what Jimmy said to me? Well, you just said it was going to 30. I know, Jimmy. I'm the one who said it was going to 30. But now the same guy that's telling you it was going to go to 30 2 days ago is telling you it's going to zero. What do you think now? And he says, fuck you. You said it was going to 30. I'm hanging in there with it. But I'm the guy that told you it was going to 30. I'm the same guy. I'm told it's going to zero now. Now you don't like me anymore? And down she went. And Jimmy still holds a grudge 12 years later. Hey, man, this guy doesn't know what he's talking about. So this whole process right here, and why I do it live room, and I love doing it live, I'm the guy that was saying the market's never going down because I've been trapped as a bear in a perpetual bull market. But, man, when I saw those signs and I told you where those cues were going, don't be Jimmy, baby! 475 on the QQQ yesterday, almost to the date. I got to tell you something, my friends. The easy shorting, it's over. Carvana got to where it needed to be. The Q's got to where it needed to be. Reddit crashed to 50% that I said. Palantir back to the $80. So now the question is, what do we do now? You know what we do now? We go right back to work. We go back to the Oracle. We go back to the Coles. We go back to the Dicks. Well, we don't have to go back to the Dicks, but we go back to the Coles. We go back to the Qs. And we go back to what we do for a living. We still have to trade. So the easy money is over, my friends. Are we susceptible to go down some more? Sure we are. But now you got to go back to work, friends, because if you didn't get rich on this rollover, you missed it. So now what do we do now, Jimmy? What do we do now, Jimmy?
What do we do, Jimmy? What do we do? By the way, so you're saying it's better to be long dicks than short dicks?
Yes. Well, right now you probably want to be long dicks, I think. I'm not even sure. The stock's got like no volume on it. I don't know what it's all about.
Yeah, it's in that range. It's in that range. Oracle, you mentioned?
Yeah, Oracle, big action yesterday. Let me show you a little faux show, bro, in the aftermarket. Hang on a second. And I'm looking at Oracle today. Again, not to save the market, but I got to tell you, friends, these next 5 or 6 days are going to be really, really important. Here's your Oracle trade.
Put $1 in the tip jar.
Most important days of our lives? Yeah.
No, every time, because we say this, it's like an inside joke. We've been saying it for years where it's like, if you ever catch yourself saying, listen, this week's going to be important. You're going to get a lot of information this week. Like, because it's such a joke because you can say that every week.
Right.
I agree with you, by the way. I just don't want to put $1 in the tip jar like you just did. We are going to get a lot of information, but that's like a bad habit to fall into because you can say that every week. But you're right. I agree with you.
Shout out to Bag of Dicks, by the way. Is it a whole bag of dicks, or is it just a bag of dicks, or is it
It's a building of dicks?
But Oracle, yeah, I mean, this was just some good action yesterday. Let me show you on my other chart where I got some VWAP action for you. Hold on a second. Boom, ba-doop, boop, boo. Bang, right here. We'll go back to the 1 minute. Here we are. Where's Jimmy? So right now, I'm a fan because I like the fact that you had a double bottom VWAP break. And again, there's a mini faux show, bro. So if everybody's still wondering what it is, the fake out, shake out, breakout. So the stock will go below a stop that generally is a low for the day, then come back, then break the VWAP. And this was one of those perfect trades. And again, I'm not too sure anybody was trading this, but the setup replicates. So there it is. You broke a new low, breaks the VWAP, and that orange line is prior day VWAP. That's our moneymaker. Forget about Jimmy, forget about where the Qs are going, forget about where we're going to be 3 months from now, 6 months from now, or a year from now. You stay focused on these trades. This is how you make a living as a day trader. Oracle now has come back to those levels. So now that it got back to that same exact level, we're going to wait for that same trade to replicate. And again, if it doesn't break over the VWAP, we're not buying it. So now that it came back here, I just wait to see it breaks VWAP. And these levels that held before, if we're wrong and it rolls over, you immediately sell it, and that's your out. So again, I'm going to be focused on Oracle. Again, yesterday was a lot better than what it's doing this morning. This was yesterday's action. You got trounced. You came back. And right here, and I'll show it to you again, it's very subtle in this one where it broke the low, came right back above the 1 minute, and it took up for 5 points. So again, we just keep looking for these stocks to replicate these chart patterns, and that's all this is. Chart pattern recognition meets VWAP. You put your trade on and make some money.
You know, Kenny's a good example of what we were just describing, which is like that feel. And it's scientifically proven, like that gut feel, like especially someone like Kenny, who's literally been doing this every morning for, I don't know, longer than anybody else, because you were there when it started, right?
Before pre-market trading, yeah. I remember when pre-market trading didn't exist. We had to wait for 8:30 for any data to start coming in.
So old. Strazza saying it's literally science. It is literally science. I'm not a scientist, but the scientists were to, consistently agree with that, which is fascinating because you do hear a lot like stick to the math, don't listen to your gut, blah, blah, blah. I think that's wrong. I think the scientists have it right. Like, from Half Baked when he's like, yes, scientist.
Scientists. Oh, my God. But you know what I love about the way that I have now traded for the last decade is I have my gut. I'm pretty in tune with the market, but I still want to let it be validated by price action. So that's what's changed me. So getting my ass kicked for 3 years between 2012 and 2015 kind of helped fighting the market. And again, that's why I'm always saying how the market never goes down until it does. And listen, guys, if you think all-time high, and I'm going to throw this one out there. I think it's going to be harder this time to get back to all-time highs. There's no way we're not going back to all-time highs, right? You know that. It just might take a little bit longer.
How long? A month, a year, a decade?
I'm going at least 3 months to 6 months. I'm going crazy right now. Okay?
But not a year.
No. I think if once we get through earnings again, April 11th, I believe we begin earnings season again. We'll see how the banks are going. And then next thing you know, we'll be talking about Microsoft, Microsoft, Netflix, Apple, Google. We'll see what the story is. And it'll be the most important earnings season of our lifetime. So
aren't they all, Kenny Glick? Ladies and gentlemen, Spencer, drop the link in the chat. Hitthebid.com. Join Kenny. If you're looking for an additional revenue stream that's very, very different than what you're currently doing, to add an additional layer, that uncorrelated strategy to lower your portfolio volatility, make money faster, all those things. I like all those things. Hit the Bid is great for that.
And listen, I want to throw out one warning. If UVXY is above 30 today, we're crashing, and you should not be wrong. So we hit 30 last night, and at the top of the fear, and we hit 30 to the big fat whole number. If we're above 30 or even flirting with 30 today, make sure you're short something. And again, it is still turnaround Tuesday. The only thing different about it is that normally you want to see the market opening up red on Tuesday, find itself, get an organic rally started. You don't want to see it starting high because usually it's more susceptible for more selling. So again,
keep in mind, let's say the market does rally today. It doesn't mean that it's going to rally through the rest of the week or the rest of the month, right? Kenny's simply talking about today alone, just to be clear.
And and also one more warning: I'm not going to be here Friday. When the market is volatile and I'm on a plane, be careful. Friday.
Yeah. Wow. Kenny, one quick question before we let you run.
Yeah, man.
If I'm hearing you correctly, you're saying downside risk is elevated, at least today, right now. Do you do anything different? Do you act differently? Are you looking for different things? Are you using different tools? Or are you just being more cautious?
Oh, that's what's wonderful about what we do, Strazza. It's the same day every day. It really is Groundhog Day. I am Bill Murray.
Right.
And it's just the same day now.
He's not as much of an asshole as Bill Murray, though.
He's a nice guy. I smoked a joint with him back in the day at some Howard Stern party. Yeah,
as long as you smoked a joint with him, how bad could he be?
He's all right. He's all right.
So you have in the back of your mind, we could plunge here, but you'll be okay because the VWAP will get you out.
Yeah, and exactly. I'm looking for I think the market's susceptible for some selling. I'd like to see those lows from last night be tested. But again, it's not a perfect science, and it is turnaround Tuesday. So we could get again we were just saying this, how when your opinion or your idea gets validated by price action, you better be in that trade because that's the magic moment. Hey, buddy, you're right. Do something about it. So if we roll over and we catch those bids and we're breaking through VWAP, I'm putting the bull suit on and we're going to be ripping those bears' heads off. But man, oh man, if the UVXY is going to show the way. If UVXY shows any strength in the beginning of the day, we're in trouble. And again, if it's over 30, we're going down, and we might even say another 3 or 4% sell off today. So be careful, my friends.
Adios, Kenny. Thanks for coming by. All right, guys, I gotta hop myself. Hopefully, Mike Hurley is good to go. Ladies and gentlemen, I appreciate you being here. I gotta hop. I got some work to do. You guys have fun. Try not to get us canceled.
I don't know if Mike is working or not, but before we bring Mike on, we have a special guest we're going to bring on and hopefully talk to Mike with us. I don't think we ever made a bumper for him, did we? No, we didn't. Or did we? Do I forget that we have it?
I don't know. I got to sneeze. I'll be right back.
I don't think we have one. Let me check right now. Do we have a? No. Oh, we got to get one for you. Let me check. Let me check my other folder before I bring you on. No. Oh well. All right. Well, here he is, Mr. Grant Hawkridge in the house. Grant,
what's going on?
What's going on?
What's going on?
How we doing, man?
Yes, I'm very good. I've had some coffee to stay up this late and join you guys. I heard Mike was coming on, so I said to Strazza, I said I gotta come in and meet him because I've never actually met him, but I've viewed his work from afar for so long.
We're gonna have a breath party this morning.
That's it.
I've been working with Mike for the better part of the last 15 minutes. We're having some technical issues. I'm gonna try. Oh wait, no, now he just left.
Why don't you go handle it, Spencer?
I'm working on it. I'm working. You guys powwow.
We'll just dive in.
I'm working on Mike. All right.
We have stuff to talk about. Go.
All right.
Okay. Grant, there's nobody better that we could have on today than Mike Hurley, and then I would say second than Grant Hawkridge. Because a lot of people don't know, so I'm going to explain to them. You do not just all the quant and stat stuff behind the scenes, among lots of other things, but you're the one who is really owns and is responsible for our risk on, risk off checklist, things like our bear market or bull market checklist, market internal checks, right? You're making decks on a daily, weekly basis, checking on the internals of the market. So when things start to crack, my friend, I would expect you to know about it first. I'm always going to Grant in times like these. So tell me, and everybody who's watching what you're seeing out here.
Yeah, I mean, I'll put it in perspective. I am not a day trader. And the way that I view the market and is a lot longer term. It's not like, long 10-year time frame, but it's a little bit longer than your, day trading, and especially like Kenny's day trading. Right. That's not my jam. So putting that into perspective, I use a bit longer time frames and try and zoom out on a lot of indicators. And look, I mean, if you've been following the daily number, I've been posting some yellow flags.
Yeah.
For the start of, I mean, I probably started posting yellow flags in December. That's when I started to see things in the market. There were, there was cracks. And I was like, look at this. And this is why I want to talk to Mike about that, is because the new lows in the NYSE started to move downwards, and we hadn't seen that for a long time. Like throughout 2024, it was, new highs. And then in December, we had this little flush down, and obviously I've been like looking at Mike's stuff, and and I really resonated with the way that he used the seasons, and me and you, Strazza, have spoken about that many years now. And I saw it, and I was like, it wasn't like a full flush down that would I would think that Mike would,
You're talking about
really
basically
excited about.
mid-December, Grant. You're talking about basically like December 18th. We had that big nasty candle. It was really like the worst.
No. I'm talking about December of this 2024. We had a little. All new highs were.
You could see
new highs throughout 2024 were, they were flush, and then all of a sudden in December we had the flush down, and new lows were more so than new highs. So. That's when I started to see cracks.
You also had the worst day of the cycle on December 18th during that selling. A little momentum.
Yeah. And since December, moving till today, I've just seen it progressively getting worse and worse. More and more things are starting to pop up, and I mean, like I put out the bull market checklist with the daily number. I post that out on Mondays, and for the last couple of weeks, I'm like, hey guys. We've lost one more. Hey guys, we've lost one more. Hey guys, we've lost one more. And then I just posted one on Monday, and I said, hey guys, we lost one more. And then after yesterday's price action, I was like, I need to do an emergency look at this, because there was a lot of action yesterday. So I need to have a re-look at the bull market checklist, and we lost 2. So now we're down to 25% in the bullish range. So it's I've been cautious through January, February. I'm starting to lean more towards with the bears at the moment. The weight of the evidence is leaning towards in favor of the bears at the moment. I mean, as we've spoken about in our internal meetings, and JC's been talking about the European strength and the developed market strength, and that's a pocket of strength. Yes, I totally agree. I see that as well. There's still I think it's over 60% of developed markets over their 200-day moving average. There are pockets of strength, but at the moment there's more data leaning with the bears at the moment. So.
Somebody who's out here trading the pockets of strength and literally day in and day out, they're drying up. We can see it in real time. Right? I was saying it at the top of the call today. There are fewer and fewer every time we look to, put on a new trade. There's fewer and fewer groups that are working where we're saying, oh, that's a pond that we'd fish in. Right. And I think you eventually look, we came in the last week, Grant, and the financials were still working in large part. The banks had already cracked, but XLF looked great. That was a pond you maybe could fish in. Now you got the defensives and Europe. That's it. Yeah. And guess what? If you look at the breakdown of a lot of these European ETFs, they're pretty fucking defensive. Okay. So I think you've lost all the offense, and you almost have to sit here and say, oh, Europe's gonna hold up the whole thing. And it's just not a bet that I can make. A couple weeks ago, I think, Grant, we could have said more broadly speaking, international is supportive. International, broadly speaking, right? Ex-US markets supportive of a bull market for global equities, and supportive of the US maybe digging in and moving higher. But there's been a lot of deterioration in international outside of Europe.
Yeah, when you look at EM, especially, there's that's starting to weaken as well. So it's developed markets with a big emphasis on sort of those Europeans. Obviously I live in Australia. The Aussie market's getting smashed. The ASX is down, 8% in a short period of time. So it's not all developed markets leading. It's a European look at the moment. So
Somebody in the chat said China and chill. I love that. I'm stealing that. I'm going to write a post titled China and chill. I love that. 2025, China and chill. That's pretty good. I don't think China is a group of stocks that you want to look to either and say, oh, well, that's bullish for the rest of the world. They just do their own thing. It's like China's like completely on an island by themselves. They're so important to the global economy. However, when you look at their stock market, it doesn't correlate with anything like ever.
They correlate highly with the Aussie markets because we do so much trading with them. So for Australian markets, China's super important. Yeah.
And they correlate with the tiny little Southeast Asia countries, but that's not anything to write home about. They're all stuck, at multi-year lows, just about. Got a nice pop, some of them.
And let's be honest, most people are invested in home country bias. So a lot of people here today are invested in US stocks. And then most people are invested in Mag 7 stocks. And I don't know if you've looked at the index lately, but that's breaking down from a topping formation. So.
Dude. I was on here last week saying we lost the mags. Nobody wanted to listen. How come nobody wanted to believe that these tops were tops? They were just such clear topping patterns that they weren't like disguised as something else. They're just classic tops. And I feel like everybody was looking at them like, no, they're not tops. Look, we leaned on the non-top and the failed top over and over and over again this cycle. These tops were different. They were very different. And guess what? None of them were failing. Instead of quarters ago when we were betting on the failed tops grants, what would happen? One would dig in, fail, and rip higher. Another one would dig in, fail, and rip higher. And then we'd start to make a list. We say, oh, all these are failing. These will probably fail too. It's the opposite this time around. I'm making a list of completed tops. And look at all the oversold readings. They're just built different. These aren't tops.
I mean, the S&P 500, the S&P 500 just switched to a bearish regime. It's dipped below 30. It's broken below its 200-day moving average. It's broken below July 2024 highs, which is the level I've been pointing out to everyone that's been subscribed to me on the daily number. That's part of the bull market checklist. That's one of the key levels that I've been watching. That's been broken. So, I mean, at the moment, the 200-day is still moving upwards. But the 50-day has started to move down. So are we going to be getting a death cross? Like that's not far away if we keep seeing weakness in the market. And at the moment, I've probably switched more cautious to throughout January and February for my own personal trading. I've been taking the cream off the top and moving my stops off. I can't tell you, and I mean, me personally, I don't short the market, and I can't tell you the last time I actually took, a long trade because I'm just like these are the times. These are the times where I want to go. I want to go play golf because
Totally.
That's where I'm at.
I feel like we're gonna play a lot of golf in 2025. Dude, the way things are looking for me, I might even get a membership. I usually don't get the membership. I can't. It doesn't work for me. I don't play enough. I think I'll probably get the membership. New bear market, I'm getting the membership.
All right, fellas. I think I got Mike. I think I got Mike. All right, we're doing this.
Yo, Jay, we've been friends for a long time. Make the call.
I mean, this is pretty professional, guys.
Nice show you got going here.
Mike Hurley. God, I miss you, brother. How are you?
I miss you guys, and I'm sorry I missed you this morning. I'm the problem child this morning.
No, you made it. You're here now. Everything's
magic.
Chat's happy. Mike, Grant, he's our breath guy. So I said, JC couldn't make it to today's interview. I said, why not? Let's just have a breath party. Let's just talk it out because what better time for you to come on? I mean, things are happening out here.
Oh my goodness. This market is something, and I'm sure you guys are, have your hands just as full as we do. It's amazing.
So how bad is it? What are you seeing? How do you feel about all this?
We always talk about fall days.
Yep.
And I did bring a chart. I uploaded it on the last attempt to get in. I'm not sure if you guys got that or not.
We should have
it. There it is. If you just can zoom in on those four charts, I hate to show so many squiggly lines.
Yep. Good.
but we had what I call a baby fall day. In fact, it was one that was really easy to miss. And I even kind of talked myself out of it a little bit. But the current market is on the bottom right. And if you look at the top two charts, for the viewers there, it's hard to see, but those are the markets of 2014 and 2018. The point being, we had a big spike in new 52-week lows several months before the top, about 7 months. And those spikes were significant. They were 700 plus new 52-week lows before the market continued to rally into its high.
Wow.
Well, the bottom left chart is 2021. We had 384 real close to the top, but we built a nice, beautiful head and shoulders there. Well, recently on the bottom right, only 250. So from 700 to 384 to 250, the difference in what kind of makes me wish not had taken it a little more seriously on the bottom right chart, though, is that number of new 52-week lows persisted for about 5 weeks. And while you didn't see a big spike and you didn't have to put your coat on for that fall day, you certainly needed a sweater. And that's why I'm calling it a baby fall day or a stealth fall day. But there's certainly divergences in place in the market. We haven't seen, until I guess yesterday, some real significant breaks of support in 200 days. But you're certainly starting to see some damage to the market and to the trend and the technicals and the moving averages and all the things you guys look at so well.
I love this. So let's unpack this a bit. Everybody look to the bottom right of this chart quadrant. This is today. And Mike, we do have a similar head and shoulders, like you pointed out, similar to the one from the last cycle, shown right next to it on the left. That little fall day that you marked 250, that happened the week of December 18th, right?
I know it was December.
Yeah, mid-December.
Right.
Yeah, it was like late December when that sort of started.
So
I trust you, Steve. Absolutely. I know you've tracked these things. I didn't have the date off the tip of my tongue, but I know it was December.
Too funny, Mike, because you probably didn't hear. You were working with Spencer to get on, but 5 minutes before you just came on, I was talking to Grant about market internals and have they cracked? Have we gotten any signal? And he said, well, mid-December, something was going on. What did if we had to classify things as a fall day, Grant, what indicators would they have showed up on back in mid-December? Like, did we get short-term new lows? Did we we definitely didn't get oversold?
I mean, I took the playbook straight out of Mike's playbook and just used new highs minus new lows and went back and did the studies. And I've seen your work, Mike, and how you've gone back into the 18 period and the 15 period and the other ones that you've shown in the past as well. I've gone back through those and I've looked at those and I mean, I looked at this in December and I said to myself, oh, there's a lot of this, it's not as big as the ones that we got in 18 and in the 14. And I was like, I wish I could have like a direct line to you, Mike, and say, hey, what are you thinking? But it's interesting to see that you called that like a stealth or a baby fall day.
Yeah, and that's why it was hard. And it's easy to talk yourself out of those little ones, Grant, because the two you mentioned in 14 and 18 were so much more obvious. It's like, whoa, 700 new lows, that gets your attention. But this 250. And the reason, again, I think we all maybe should have taken it a little more seriously or took it seriously enough if you did, is because it persisted. I mean, you never saw a 1 week dip in new 52-week lows. It hung around for 5 weeks.
And it's also the change in character, right? Like this is a net ratio, so it could be positive or negative. It was positive all year, right, since late 23, and then all of a sudden this was its first little blip in the negative territory.
Well, and that's what
picked up my ears.
Right. As you know, both of you guys know, that's what that fall day is they occur, as you can see in those vertical red lines, near the top of the market. And so when the market is at a new all-time high, usually breadth and leadership is good. It's when you have the market at an all-time high and, things aren't so bueno, is that it gets your attention. And again, it wasn't 700 like we usually see, but boy, that was a rough week. And I remember we were trading email during it, and I can't remember if I got on the show or not, but it was a little bit, too mild to really sound a huge red flag like we did during COVID. I remember we were on during that week, but it certainly was degradation in the trend.
But also, this gets more complicated. It's harder than we're making it sound in hindsight. Think back to what was going on in December too, right? It was the post-Trump rally. Everybody's freaking out. He's so good for the market. Nobody was paying attention to the cracks, right? It was just all these bullish headlines, positive news, very different from COVID.
The only other thing I'd say that was different, and if Spencer could show the second chart, I'd be grateful. You got to
Next
look
chart.
where you are within the cycle. And, we have the shotgun chart, and I like to put all the different market cycles starting
Yeah.
at the same point in time.
Oh, yeah. Look at
And
this thing.
now there's a lot on here, and I'm happy to send it to any viewers if you want. But the table on the left shows every market cycle, bottom
Zoom
and
it
top,
in again. Zoom in again, Spencer. Sorry, Mike. Go ahead.
since 1932. So again, a lot of numbers in the left. The point being, if you start from the October bottom 2 years ago and reproduce with one point in time the top in price and time, you get a bunch of dots. And it looks like they're not lining up exactly right on the chart there, but all those red and green blocks form a little shotgun pattern around the yellow circle. The point being, the average bull market is 3 years long. The average bull market makes 100%. And there's a pretty good cluster of data in there within that period. And we are in that one standard deviation yellow circle, and 2/3 or 68% of the tops since 1932 have occurred in that one standard deviation circle. So when you start getting into that circle and then seeing weakening internals, I think you got to take it seriously. And that's why I think you've got to take it seriously now and maybe, get that golf membership I heard you talk about.
Okay. So this is great. This is so perfect, right? Because we need this context to have the right perspective on this Where am I? Where's my face? There I am. What Mike just said, everybody, is if the bull market ended right here today, it would be completely normal. Is that fair? In terms of
Yeah, it'd be
performance
a
and
short
duration?
one. They're usually 36 months, but hey, we're 29 into it. So it's not out of the realm. You're within one standard deviation of the average in both type, time, and price.
Grant,
Do you find from your work that the year 3 of the bull markets are a bit more toppy?
Yeah.
Because I've done the work, and I've been sharing that chart of like year 3 of a bull market. And when you look back, I don't go back as 32, but I've gone back, 50 years. And usually year 3 is just a sideways choppy mess.
And it is on average. I've seen some things like that as well. The reason the average is that way, in my view, Grant, is because, sometimes you peak a little early, sometimes you peak a little late. And that's why I like this cluster of dots, because it shows you where they are. And again, I think on this slide that I sent you, it didn't come out quite right. It looks like stuff is slid off to the right there. But I'll send you guys a PDF that puts everything lined up. And it really does look like you took a piece of paper and, shot a shotgun at it.
Yeah.
The history doesn't repeat exactly, but it certainly rhymes. And that's your point, is usually in the third year, you get some kind of top somewhere. So for clients in our investment advisory firm, and again, I also work for an asset manager, I'm not exactly sure where the top is. We may well have seen it, but we may see one more push, as you mentioned, Grant. But regardless, if someone usually has an aggressive model, good time to put them in moderate. If someone likes the moderate model, good time to put them in conservative, because we're just in that third year and you're starting to see weakening, and it's time to downtick, time to downshift.
Do you usually look for some sort of like euphoria stage, like blow off leg to end things? And would you look at the action from November, guys, and say maybe that was it?
I think you can, Steve, and I think you're probably better at it than I am. When I look at market sentiment, I usually look the other direction, and it's easier to see panics than blow-offs to the upside. Now, commodities often have V tops, but stocks often have V bottoms. And one of my favorite signals, which I thought we were going to get maybe yesterday, but we didn't, is I like to put a 5-day simple moving average on the VIX. And you never know how high the VIX is going to go, right? Maybe it peaks at 20, maybe it peaks at 40, maybe it goes to 60 or 80. You never know how bad it's going to get. But when the VIX comes back through its 5-day average, usually the rout is over, the panic is over. And we were right on that on Friday. And And I thought, all right, it's a little bit of a reversal day. Maybe Monday is the day the VIX finally breaks and we hold the 200-day. And man, yesterday was a crummy day.
Yeah, they really sent them lower
To
yesterday.
say the least, we didn't get the balance.
Jeez.
Yeah, no, it was
So-
straight weakness, wasn't it?
Grant, isn't there a lot of reporting out there about how this would be like a strangely short or abbreviated bull market cycle? Where is that coming from? Do you know?
I mean, journalists being journalists, maybe.
Okay.
You know,
Have
I think it's still it's year 3 of a bull market. I mean, all my work and all my studies is saying that we might be in for some cautious times, and that has been the case. And I've been saying that since January, February. Like, I mean, essentially since that spike, that stealth fall day that we had in December.
Yeah,
Okay.
the baby fall day or whatever we want to call it.
So we got the baby fall day. If I remember correctly, Mike, now you're really letting price do the heavy lifting in your analysis. Now that the fall day is in, is that right? What kind of levels are you watching?
You're probably fair to say that, Steve. But once you have the fall day, I guess I really use that to decide when to take divergences seriously, because you can see a lot of divergences in a bull market, and you guys have seen a million of them too. They happen in the first year, they happen in the second year, and you can kind of ignore them. On the charts that I pulled up today, you can draw divergences on there a lot. You don't really care about them, and you want to ignore them the best you can until you get the fall day. So yes, price matters, and I think as Chris Verone says, bad things only usually happen when you're below the 200-day average. They don't usually happen when you're above the 200-day average.
Yep.
Well, now we're starting to talk about a different regime. I think at a minimum, again, advisors ought to downtick their risk in their models. I think you can play both sides of the market because, again, as Grant says, this could still roll a little more. Maybe we see a right shoulder, maybe we don't.
Right.
But there's some charts out there that look pretty terrible, like FedEx, that I think are important because they're economically sensitive. But then there's some charts that look okay too. So, IBM and some of the gold stocks. So it's a mixed market. And if you're a trader or speculator, you can find both sides to play. But if you're just a long-term investor, you had a good 2 years. That was the easy money. Now's the time to be careful.
And when I look at a pattern like FedEx, because that pattern is everywhere, 12-month plus prolonged distribution pattern. It looks like Microsoft, frankly, FedEx. They're nothing.
That's a good comparison.
But yeah, they look so. That chart pattern's everywhere. That's the kind of distribution formation that I just know I'll look back at if I don't get out, right? As those are completing, I'll look back and say, you stupid ass. I mean,
what were you thinking? Exactly.
Right? So it's just too many of those patterns right now, Mike.
Exactly. And there are.
All right, Grant.
And a lot of those patterns are breaking to the downside.
Yeah, they're starting to resolve to the downside.
Yeah, too many. All right, Grant, you got any other questions for Mike?
I just want to know, we're all about pattern recognition. When you're looking at the new highs and new lows, you use weekly data. I bring it back to daily. And like, if you can throw up slide 61, it's the pattern from the current pattern that we're seeing in the new lows, new highs is very similar to what we saw in 21. I just wanted to, if you can show up, no, 61, unless it's been changed. 62, sorry, it's been changed.
Boom.
See how at the bottom there we've got the new highs minus new lows, and I just wanted to point out like the pattern looks so similar to 21. I just wanted to get your thoughts on that. Like, are we going to? It's a bit silly to ask, but could we see a prolonged similar pattern? Because it looks very similar. And we're all about pattern recognition and cycles, and we repeat ourselves. We're humans. We repeat ourselves. So, do you think
we do? And you've got a whole new generation of traders coming into the market all the time. And a lot of the older guys on Wall Street are leaving. So, human nature is such that we all have to skin our knees ourselves and make the same mistakes. So they do repeat. I think there is a similarity there, and I also think the actual S&P, it reminds me of that very narrow top, I want to say in 15 or 16, where the market traded for 6 months in about a 5% range, top to bottom, before we finally broke to the downside. So again, you're right, Grant. It never repeats exactly, but there's some similarities here. And then you mentioned the daily charts, and I'll be quick on this. I do typically look at weekly data, and I've written about that a couple different places, and I was actually flattered to actually write the chapter for market internals for the CMT exam, and I think you guys have a copy of that.
Can't wait.
But mostly weekly data is in there, and I talk about why I use it. But the daily example that comes to mind is 1998. If you look at that rally in the summer of 98, before long-term capital almost killed the world, you had a pretty beautiful divergence in the number of new 52-week highs. You had a strong rally into the first half of 98, a trading range develop where market internals, normally fade away because you're in a trading range. And that, again, makes it a little bit difficult for guys like the three of us, because you should see some congestion, no new highs when you're in that range. But then when we broke out to the upside in July and you never saw the new highs expand, boy, that was just like a person on a high dive waiting for the water to come in, and it never did. And
I mean, I look at that data from 98 and it looks similar to what we're seeing now. It's the same
and that's
sort of
why I
pattern.
pick it up, is because, again, the weekly stuff looks similar to the years we mentioned, but the daily, without the extra rally in the S&P, the new high, new low data looks very similar. It just never really got back going after it faded off. You never saw a resurgence in new highs.
That's great. All right, Mike. Well, thank you so much for joining us. The breath god, everybody.
I don't know about that, but you guys, I love being with you because you're so sharp on it yourselves, and it's so fun to compare notes. Thank you for having me on. It's always an honor, and I look forward to doing it again soon.
Awesome.
And I'd love to connect with you offline, Mike. And
deal. I will send you my contact info. And Grant, it's great to see you in person.
Yes,
you guys need to trade notes for sure.
Yeah,
thanks as always, Mike.
Thanks, Mike.
Just so good. Boy, are we blessed to get to have these kinds of discussions and do it live for you guys on YouTube. So cool. There's nobody I would rather talk to right now with breadth in question, market internals in question, the market rolling over. I mean, this is one of the top guys. So what a treat that was. Spencer, did you learn anything? Were you taking notes?
I was not taking notes. I was doing a small amount of multitasking, but I was listening. Yeah, you guys are like up here. I'm just starting. Like my knowledge base is like down here. You guys is up here. So yeah, that was a great conversation. I did learn a lot. And we need to get Grant and Mike together more often, because that was you guys speak the same language.
If he was still here, I would have asked Grant, I wonder if there's anything to be made of the fact that the fall days keep falling in number. I wonder if there's some sort of, it probably doesn't help to rack our brains about it, but we're getting smaller.
You're saying that they're not getting as deep.
Yeah, you're not getting to the 700s, right? Last time we got to the 350, now 250. Is there some sort of dynamic that's impacting market internals? Like we talk about Mag 7 dynamics and all these different things. That kind of stuff does affect breadth over time. We usually don't catch it in real time. What we do as analysts typically is we look back 5-10 years. Oh, that's why that data changed and got really weird, right? Oh, this thing was going on, right? So I'm just wondering, because there's a change in character there with the fall days. Anyway.
So this time it is different. Maybe we'll find out. I don't know.
It's.
I mean, what's the old saying that we always say? This week Mike will tell us some great information.
I heard JC talking about that, and a lot of times we're the ones saying that, but everybody's been saying it out here on the internet, so it's nice to see. It's important.
You say it in jest, like
I do.
Big week, lots of information, most important week of our lives, most important Fed meeting of our lives, most important earnings season of our lives, most important election of our lives. Everything is the most important of our lives. We didn't even get to some of the stocks that were like Asana. Steve was getting destroyed today because your boy
Dustin gone. Yeah, they lost Dustin.
sailing off into the retirement sunset. I didn't know that was allowed.
This guy, Spencer, as much as anybody, has shown up on Hot Corner over the course of the past year. Just like monster insider buying. He has endless money, I believe, from Facebook.
He owns more than half of the company.
Yeah, but he's gobbling up shares. And it's just strange because typically if you're gobbling up shares with that much conviction, you're planning to hang out and run the show, right? So he gobbled up all these shares and then departed. It is strange. He's
going to be still the chairman. He's going to be the chair, right? He's just not going to be the CEO.
These guys, man, like the founders and operators that you want are the ones who, frankly, they don't want to let go. I'm thinking again, because I just finished the show. You would really like it, Spencer. Super pumped. It's got that kid. He's such a popular actor. He's
JGL, right?
What's his name again? He's got 3 names.
Joseph Gordon-Levitt.
Gordon-Levitt.
Yeah, he's great.
Like everybody's in it. Like Uma Thurman's in it. They do all the characters. Like Bill Gurley is so good. He's played by some good actor too. Uma Thurman plays Ariana Huffington, and like they go through it. Like Bonderman has a big role in it. They got Abby Joseph Cohen, I think, or Abigail Johnson, the Fidelity lady. Okay. So they really like go through the whole story. And Travis Kalanick, man, what a bad man.
I just discovered that there is. I found out the other day that they made a Spotify show. There's a show about Spotify. It's a Swedish show. It's on Netflix, I think, or Amazon. It's called The Playlist. It's about the founding of Spotify. Didn't know that was a thing.
I'll pretty much give every one of these a shot, right? Like, especially like these biopics about these interesting characters, like in this case, Kalanick, Steve Jobs. They usually do a pretty awful job, but if they can like stick at least loosely to the story and the things that happen, they can be some pretty good shows. I really enjoyed the Uber story, I guess.
Yeah. All right. I'll check it out. Grant, thanks for hanging out, man. I know it's late for you. We appreciate you guys for watching. Thanks, Mike Hurley, for powering through that. And we'll be back tomorrow. We have a lot to talk about still. It's a lot of things we didn't cover this morning. We didn't talk about the airlines. But yeah, Steve, we're only just starting now to get that first wave of revisions, right? And saying,
they all talked about dollar headwinds last quarter, the strong dollar ruining their earnings. Now the dollar is absolutely collapsing, and these same companies are coming out and lowering their guidance.
It's not me. It's the economy. What do you want me to do? I can't. I don't know. Yeah. I don't know.
They did the Fed now forecast. It drops like 4 percentage points. These things, just pay attention to the speed at which a sell-off comes into place, feeds on itself, rips everybody to shreds, and then ends and leaves you in the dust. Just pay attention to how fast these things happen.
Yeah. All right. Thanks for watching. Smash the like, please, and thank you. Comment, subscribe, email us, all that good stuff. We'll see you guys tomorrow. Go make some money or play some golf or whatever makes you happy. I don't know.
Grant, thank you so much for staying up so late to hang out with us today.
Appreciate it.
What a treat.
I appreciate it. I love being here. I should do it more often.
This was
Definitely.
fun.
All right. Bye, guys.
All right. Thanks.
I can't take no loss. I don't even know what it costs.